What the Trump administration is trying to do is make it worse, but flooding the economy with more cheap money to sustain a housing bubble is bullish for gold and silver. The Trump administration, all they care about is making the economy look good until Trump leaves office. The last thing they want is the bubble to deflate while he's still there, right? And so they got to do whatever they can to blow as much air into this bubble. That's going to mean maximum pressure on the Fed to cut rates, which is why the Fed's going to cut rates. And when they get a new FOMC chairman in there, they're going to go even more. The Fed's going to go back to QE to prop up housing, to prop up the market. Maybe they'll think they can prop up Bitcoin. Who knows? I don't know if there's any way to get the air back in that bubble. There's probably too many holes. All the dips were buying opportunities. Don't be afraid, right? A lot of people, they see this volatility and it scares them out of the market. You know, at some point, $100 drop in the price of gold is not going to be very much. It already is not that much when you're talking about 4,000. But wait till it's 10,000, right? Then $100 is an even smaller move, 1%.
Economist Peter Schiff breaks down why current U.S. policy decisions are accelerating the bullish case for gold and silver rather than stabilizing the economy. He argues that the administration's strategy revolves around one primary goal: maintaining the economic illusion until the end of the presidential term. To accomplish that, massive pressure is being placed on the Federal Reserve to cut rates, revive quantitative easing, and push cheap money back into housing and asset markets. While these efforts temporarily inflate bubbles, they ultimately weaken the dollar and amplify long-term systemic risk. Schiff notes that every dip in precious metals should be viewed through this lens: volatility within a rising trend, not a reversal. In a world where gold could eventually reach $10,000, a $100 move becomes insignificant noise, and silver follows the same trajectory as monetary demand rises. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Rate cut in December is no longer a sure thing. It's basically a coin toss at this point, based on a lot of comments made by FOMC members that they're not really sure, what they're going to do with rates. And so that was hurting risk assets. But it's interesting, money flew into gold and silver, even though they're talking about not cutting rates. People think, oh, that should harm gold and silver because, gold and silver want interest rate cuts. But because they may not cut rates, investors want safe havens, and that's gold and silver. And by the way, it doesn't matter to gold and silver if the Fed cuts rates or not. What matters is they're not raising rates, and they should. Interest rates are too low. They were too low before they were cut. They never should have been cut. And because they were cut, and because everybody knows the Fed's not going to hike, no matter how high inflation rises, well, that's bullish for gold. But other things that happened during the week that were bullish for gold, what the Trump administration is trying to do is make it worse, but flooding the economy with more cheap money to sustain a housing bubble is bullish for gold and silver. It's just another development on the week that is going to drive more money into gold and silver out of U.S. dollars. Look, this whole bubble is deflating in crypto, in AI, housing, right? In the bond market. Look at bonds getting beat up, and they're doing whatever they can. They have to stop. I mean, they don't have to, but as far as they're concerned, they have to, because they can't allow a recession or a financial crisis, even if in the long run it's something we need. In the short run, they don't want that, right? The Trump administration, all they care about is making the economy look good until Trump leaves office. The last thing they want is the bubble to deflate while he's still there, right? And so they got to do whatever they can to blow as much air into this bubble. That's going to mean maximum pressure on the Fed to cut rates, which is why the Fed's going to cut rates. And when they get a new FOMC chairman in there, they're going to go even more. The Fed's going to go back to QE to prop up housing, to prop up the market. Maybe they'll think they can prop up Bitcoin. Who knows? I don't know if there's any way to get the air back in that bubble. There's probably too many holes. But since the president's family is all in on crypto, they're obviously going to try to do what they can with cheap money. And so all this is going to drive the dollar down. Surprised it hasn't already dropped, but it's going to drive gold and silver prices much, much higher. So as I said earlier in this video, a volatile week, but all the dips were buying opportunities. Don't be afraid right? A lot of people, they see this volatility and it scares them out of the market. At some point, $100 drop in the price of gold is not going to be very much. It already is not that much when you talk about 4,000. But wait till it's 10,000, right? Then $100 is an even smaller move, 1%. The volatility in silver, I think it's all a positive. It's all a sign of a breakout, but it is keeping some investors who might otherwise buy on the sidelines while they watch as speculators as the market keeps going up, and they're too afraid to come in. At some point, that fear will be replaced by greed. We're not there yet. All of the greed is still in Bitcoin. Now, eventually, that greed is going to turn into fear. And that's when the bottom is going to fall out of the crypto market. We're not even close to the bottom yet, right? We got a long way to go down, but we have a long way to go up in gold and silver. And, as more and more people have confidence in gold and silver, they're going to lose confidence in Bitcoin and the rest of crypto.
Peter Schiff explains how shifting expectations around Federal Reserve policy are reinforcing safe haven demand for gold and silver. Even as FOMC members cast doubt on a December rate cut, investors moved into precious metals, not because rate cuts are inevitable, but because the Fed has effectively ruled out meaningful hikes despite persistent inflation. That policy backdrop, combined with ongoing efforts by the administration to sustain asset bubbles through cheap money, directs capital away from the weakening dollar and toward tangible stores of value. Schiff argues that volatility in metals should be viewed as a sign of strength building beneath the surface, especially as broader bubbles in crypto, AI, bonds, and housing begin to deflate. He sees confidence steadily migrating toward gold and silver as speculative excess elsewhere unwinds. Let's get into the interview.
Silver again soared over $1. Gold was up over $50. And then near the open of our market, or just before, there was a huge sell-off. And gold dropped like $130, $140. Silver dropped over $1.50. Not from the high, but went from up over $1 to down more than $1.50. So more than a $2.50 swing in the price of silver between the time U.S. markets closed and U.S. markets opened. But I think what's the most significant about all of this volatility is that it's taking place above 4,000 for gold and above 50 for silver. That's what I've been saying. 50 is the support for silver. Now, it can trade below it, but that's really where the support is. That doesn't mean it can't trade 49 or even 48, because silver is inherently pretty volatile, and so it's hard to stop at a round number. But this is about the support. Gold, 4,000 is key support. And we've managed to go below it, but not by much. Gold never went below 3,900 after it went above 4,000. The lowest I saw was maybe 3,910 or 3,920. Silver did go below 50, but then it came soaring back. I mean, when silver almost hit a new high on Thursday night, gold was still maybe $200 away from a high. Gold got, less than 200, but because gold got back above 4,300, I think. But after today's sell-off, it's back below 4,100. But this is very constructive trading as far as I'm concerned. 4,000 is the new 3,000, just like 3,000 was the new 2,000. And silver, when silver was at 40, I said 40 was the new 30, and now it's almost like 50 is the new 40. Yes, silver did go below 40 a few times before it rocketed up to 50, and that's why it may go back below 50, especially when we're only 60 cents away. But I wouldn't wait. I think that today's sell-off was another buying opportunity for Schiff Gold customers to go to the Schiff Gold website on Friday, on Saturday, and even Sunday morning, because I expect another big run-up in gold and silver prices Sunday evening into Monday. Now, maybe it won't be sold off in the U.S. time zone. What I've managed to notice is that the big sell-offs happen later in the week, not earlier. So there's a good chance that we get a big run-up on Sunday night and then an even bigger run-up on Monday morning as Americans who got out of their silver and gold rush to get back in. So it's another great weekend buying opportunity at Schiff Gold to load up on gold and silver in particular, which I think has got an explosive move that's coming. But a lot of other things happened that are bullish this week, fundamentally, for both gold and silver. So one of the things is the carnage in crypto. It's pretty clear that there is a major rotation going on, and it's not just from growth or risk type stocks to value dividend paying stocks. That's happening too. But it's a general risk off trade. Not that all equities are risk off, but portfolio managers seem to want to have less risk. So the most riskiest assets are getting sold and people are moving into other assets that have less risk. They don't want to move into bonds, right? Because the old safe havens are no longer safe anymore when you have inflation as the primary risk and a dollar debasement. That's why Treasury prices were also down today and down on the week, and yields are rising. But we saw moves down in tech stocks. Tech got hit pretty hard. In fact, the NASDAQ was down about 4.5% on the week. In contrast, look at gold and silver stocks. The GDX was up 5% on the week, almost as much up as the NASDAQ was down. And the GDXJ almost up 5% as well. Now, of course, these gold and silver mining stocks would have been up a lot more without the losses from today and yesterday, right? And so it could have been a much bigger move. And I think it will be a much bigger move next week as the rotation out of risk continues. Because yes, there's risk in gold mining stocks, but not nearly as much as there is in these tech stocks. And there's a lot more earnings behind them. There's a real strong fundamental story for the gold stocks. In fact, Barrick Gold came out with its earnings Monday, and over the first 3 days of the week, Barrick Gold was up 13 or 14% before pulling back with these violent, sell-offs in gold. But that highlights the powerful potential of the gold mining sector to earn money in this gold bull market. And so this is bullish for gold because it's going to bring more money into this sector, but also it's what's happening in crypto because crypto got beat up the most, more than just AI-related stocks. It was anything even tangentially related to crypto.
What this week's action ultimately confirms is that the structural momentum behind gold and silver is strengthening even as volatility remains intense. Sharp intraday swings, whether driven by algorithmic selling, thin liquidity, or end-of-week positioning, are happening above key breakout levels, reinforcing the argument that higher floors are being established. The rotation out of high-risk assets, from crypto to speculative tech, is no longer theoretical. It's showing up directly in capital flows, with miners outperforming even on days when gold is dragged lower. Rising yields, weakening confidence in traditional safe havens, and relentless liquidation in overvalued sectors are funneling investors toward assets supported by real supply constraints and expanding profitability. As selling pressure exhausts itself, the setup favors strong upside continuation in precious metals and mining equities as the next phase of the rotation accelerates. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.